It is the first week in May, and the S&P 500 is at an all-time high. This show is about the recap of the first quarter earnings report for 2026 so far. The earnings reports season normally lasts about 6 weeks. So it goes this time from the middle of April to the end of May. So far, about 40% of companies have reported. So 81% of those companies have beaten revenues. Normally, that's about 67% over a 10-year average. Earnings per share, about 84% have beaten on earnings per share. Normally, that's 76% on a 10-year average. And market-wide earnings growth is market-wide 27% so far, earnings growth. That expectation was 13, so it has more than doubled the expectation of their earnings growth, which is amazing. However, price action, we've talked about it before. On those upside beats, the average stock has only moved less than 1%. So to me, that means looking at the price action, that which is basically, is there net buying or is there net selling? Very simple. What is the price action? So that is a little bit of an indicator when we've got these incredible beats and very little movement in the price. So again, just to review price action, know today's price, know your 50-day moving average and your 200-day moving average, and know when those come close to each other and cross over, okay? So a little bit of statistical analysis there, a little bit of technical analysis. Let's talk about company specific. Let's talk about the Mag 7. The best of the Mag 7 was Google. Google killed it. Big surprise of they were expecting $2.62 per share and of earnings. They actually got $5.11, a 95% beat on earnings. And there was some unrealized gain on the balance sheet from investments like in Anthropic that have yet been realized, but their cloud revenue grew 63%. Their search revenue was up almost 20% for a company that is over $4.5 trillion in market cap. These are amazing numbers. So Google absolutely killed it. And I just want to reflect that about a year ago, of all the Mag 7, Google was the most hated. So many people were saying that AI was going to kill Google, kill its search, and the company was never going to recover. But Gemini, which is Google's large language model, is currently ranked #1 in blind human preference tests, and it's the only large language model to handle query sizes over 1 million tokens long in size nearly flawlessly. So my lesson learned is, please be careful about betting on human predictions about what's going to happen. Deal in the here and now. And speaking about predictions, I'm just curious in my mind then, I think, what about software? Because it's so hated right now. So just throwing that question out there. Let's talk about the other 493 stocks of the S&P 500, excluding the Mag 7. Of those 493, 10 of 11 sectors were positive, had positive earnings growth. Only healthcare was down, negative. And that was due to a confluence of lots of blockbuster patent expirations. So kind of a, little bit of coincidence there and convergence of these blockbuster drugs expiring their patents. And what else? Consumer discretionary sector grew almost 40%. There was a ton of home improvement. So people are improving their homes. They are not moving. Of course, we've talked about mortgages, but companies like Home Depot and Lowe's reported great earnings. Also, people are turning to hobbies as a way to cut costs and still have some fun. So companies like Michaels and Barnes& Nobles, they had great earnings too. A no-brainer is that energy, of course, killed it. In the first quarter, 100% of the energy companies have beaten their revenue estimates. And already for the next quarter, there's been a 45% raise in the expectations overall for the energy sector. So nothing earth-shattering there. And financials, the banks and financials were very strong. Inflation stayed high, so interest rates, of course, stayed elevated, which means that their net interest margin and their net interest income were both really solid, the money that they make on loans. And that was more than offset the loss from loan loss provisions and credit loss provisions. So, and those unfortunately are due to a weakening consumer. We talked about that last show about how those have been going up, but the banks are still doing well, and they've offset those higher default rates among consumers. So, what else? The CBOE Global Company reported almost a 30% jump in options trading, specifically short-term index option volumes. So that's mostly from retail investors. And a little bit of a concern for me there is that as gambling has seen such a massive increase, stocks and options are following a little bit the prediction markets. And we've talked about the time value of trading, that if you take a fundamentally solid company, that their probability of success increases the more time that you're allowed to, be involved and to hold that company. So the time matters. Look, options expirations dates, whether you buy an option and it expires in a week or expires in a month, that expiration timestamp is hard enough. It's hard enough to make money on that. But zero dated options, where someone buys an option that expires that day, or sometimes even the next, depending, but basically expires right away. To me, that's really getting close to gambling. You're guessing on a one-time event, and you completely lose that time buffer. So it's all or nothing, and not my cup of tea. But what else? The industrial sector struggled from higher borrowing costs, which were caused by inflation, of course, and geopolitical uncertainty, specifically the Israeli-US-Iran war. And materials were the second highest earnings surprise after technology, and that's due to construction demand solidifying their pricing power. Lots and lots of demand from construction. And as a side note, gold. Gold has seen its momentum from last year before broken. The momentum is gone, and it is now trading as a risk asset. It is no longer a hedge against inflation or a safe haven. So just something to keep in mind. Historically, people have run to gold in times of trouble and when inflation was rearing its ugly head, as they say, but just watch out for that one. In case things turn nasty, I'm not sure that gold's going to be there for us. So the 493 without the Mag 7 in aggregate, their net profit margin for Q1 for the first quarter was 13.5%. Unbelievable. 13.5%, which is the highest since the great financial crisis of 2008. So right now the market's riding high on earnings beats. There's a lot of optimism out there, but I have a question: that is that optimism enough to counter the effects of the rising probability of inflation and the rising probability of a slowing in global growth? Rhetorical for you and me. So to wrap up, the last 2 months saw a pullback in March, and there was a big drop in volume. So people sold and they sat on the sidelines and they waited. In April, they came back in and they, surprise, surprise, bought the dip. And they went back in specifically into AI and tech names, specifically into those ETFs, exchange traded funds. And at the top of the year, we started to see a broadening trade into smaller cap stocks. That broadening trade is exhausted. It's no longer in effect, and The market is narrow once again, and it is led by semiconductors and those generals of technology. So the last thing is, that caution is at the top of my list. So as a reminder, we have a new Fed chair this month who has promised to shrink the balance sheet, the Fed's balance sheet. That means that they're not going to keep buying treasuries as they mature, and which affects interest rates. It means that interest rates could go higher if they're not doing the buying there, if they're not that extra buffer, that extra buying. We have midterm elections in fall. We have historically a negative for the market. We have a hot war in the Middle East. Each day that the Strait of Hormuz is closed, the chances increase every day for higher inflation and lower growth. We've talked about it many times. And that I purposefully avoid giving advice. But if I may, please, just just stay a little nervous, okay? Stay a little nervous and dive a little bit deeper into your fundamental analysis and find those great companies. This is the time in my mind for me to be a extra cautious, specific stock picker, individual stocks. And so do that fundamental analysis and, of course, have fun trading. Otherwise, why are we doing this? So thank you all, and I will see you next time. Cheers for now.